Picking the right indexes or ETFs to invest in when trying to start investing is one of the most difficult tasks. And when trying to find the right index, you will be overwhelmed by all the many there are. And when you do find the right one for you, you will find out that every single index is tracked by 100 different ETFs. So in this video, I will highlight the indexes which are most invested in, and I will show how they performed against each other in the past. Yes, welcome back everyone. Thank you for staying around. So in this video we will compare indexes, but to compare indexes we will actually compare ETFs which track indexes. So I picked five, I think five very kind of diversified ETFs from all around the world, which I see used a lot in combinations or standalone in people's portfolios. And these are the S&P 500, which is a no-brainer, of course. It is mostly seen as the benchmark, as the market benchmark. So if you beat the S&P 500, you can say that you have beaten the market. It's not officially that way, but many people see it as the market. Then we also have the core world, so basically stocks and obligations and stuff around the whole world. But there is, of course, a lot of overlap between the S&P 500 and the world, because a lot of these big companies in the S&P 500 are also big or relatively smaller, but quite big positions in the world. And then we have the emerging markets. So you can think about Asia, South Korea, Taiwan, but also a little bit of Brazil. I think there's a little bit of Israel in it. Just emerging markets, which are expected to grow. And then we have the Nasdaq 100, the 100 biggest technology companies. So this one is used a lot. Almost everyone I see has a part of their funds invested in an ETF which tracks the Nasdaq 100, together with the S&P 500 and maybe the world, but maybe then a Vanguard ETF about the whole world. Maybe those three are the most used. And I also wanted to stick in the iShares Core Europe, just to get some diversification towards Europe. And I think these four or these three have a lot of overlap in the stocks they possess, but then they differ in what percentage of the ETF is actually that stock, blah 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 blah. Because Apple is in every one of them, Tesla is in every one of them, Alphabet is in every one of them, Microsoft. You can name them. Emerging markets, I think you should think about semiconductors of Taiwan and stuff, Samsung maybe. So maybe some, no, I don't think there's any Japanese in there, but that's not very emerging anymore. And Europe, when thinking about Europe, you should really think about luxury goods. So Louis Vuitton, but also Nestle. Yeah, so that's it. And we're going to compare these indexes. And to compare them, I made this, or I used the site Just ETF. I will stick the link of this particular part of the site in the description. And we can actually see the return it had in the past period. So 3 months, 6 months, 1 year, 3 years, 5 years. For me, as a long-term investor, I think it's only interesting from the 1 year on. But just to get a feel of it, we will also look at the 6 months. So as you can see here, emerging markets has done very poorly in the last 6 months, and all of the other ones actually performed quite well. Of course, I don't know how long you have been investing for, but 14% in a year would be very nice. And in the last 6 months, I mean, yeah, that's just very good. Let's see if we can also get yield to date. Yeah, so yield to date, that's from January till now. You can see 23% in the S&P 500, 20% for the world, then only 2% in emerging markets. You should stick your own label to it, to what that means, but to me it creates interest. maybe you can buy it low, but there could also be something else going on, which just means that it is performing very poorly and that it will not perform well, or that it has grown very much in the past and is now a little bit moving sideways. We can see the Nasdaq this year, and I say that with a reason, but we'll get to that later, is 21.8, 21.7%, and Europe is 19%, which are all very high percentages. So when looking at this, S&P 500 beats everything again. Nothing beats the market in this case, or no different index beats the market, which is very interesting, because it's almost becoming a cliche to invest in the S&P 500, but as we see here, that cliche is very much justified, at least for this year. And in the past year, of course, last year it grew quite a lot after the crash in March. So I don't know how reliable it is, but it is still, everything dropped in March, so you can still compare them. We can see that in 1 year, all the indexes grew a lot. Europe grew a little bit less, and emerging markets a little bit less, but this is also very much caused by the yield to date in the last 6 months, I think. If it had these 8 percentages, I mean, you cannot just add it to it. That's not how percentages and cumulative percentages work, but they would have significantly more. Then last 3 years, that's why it was interesting, the 21.7 compared to the 23.8%, because in the last 3 years, Nasdaq actually grew the most with 100% in 3 years, which is a lot. And S&P 56, emerging market 25, that's not so good. Europe 30%, also not very good, but the world index and the S&P 500 and the Nasdaq all grew very well. Now 5 years, we can actually see that the Nasdaq has 208%. So you should just think, if you 5 years ago you invested $100, that would be over $300 right now, which is a lot. Definitely if you invest in bigger sums of money, that's a lot of percentage. S&P 500 also performing very well, and world 87 is also very good. Emerging markets a little bit less, in Europe also a little bit less. We see that to the 1 year period, Europe was performing a little bit less than the other indexes based around the world and kind of around the United States. It could keep up, but after the 3 year period, to compare them, they start to slow down a little, and in 5 years 54%, and you could do better. So yeah, these are all the percentages. I think they're very interesting. You can also always make a screenshot of this and look at them yourself. I hope this helps you to get a clear view of what you want to invest in, and to at least know what the differences are in the indexes for at least the last 5 years. I forgot to tell you, but it's quite important, that all these ETFs are accumulating. So all of them are, so they can still be compared. Accumulating means that the dividends coming from an ETF or the companies within an ETF immediately get brought back into the ETF or into its holdings, and you will not get it. It will not be distributed, which is the other side of the argument. And then also these line charts, I think they are quite interesting and good for your visualization. I will go over all the periods. You can make screenshots if you want. This further gives us an idea of how the index is performed. Of course, we see emerging markets, Europe probably the lowest one, and then S&P the highest one. That's yield to date. And then we go to 1 year. Everything is quite together. And here we can also see the full story of emerging markets, because it was at 30% already in 21, but after that it did not grow anymore. it went kind of a little bit down and then it went sideways. This can still be considered sideways, I think, this little period. And then 3 years, we can actually see that Europe is also down there and that the Nasdaq grows exponentially more. And then 5 years, that view is only made stronger with the S&P under it, world under it, and then emerging markets and Europe kind of moving along. So yeah, if you wanted to make screenshots of this, just pause the video and you can look at it in your own time and look at it again. Looking at it again definitely makes you learn it better. I think it's very interesting. I hope to give you with this a good comparison of it and to enable you to make the best decision you could possibly make. If you have any questions, you can always leave them in the comments. And as for now, this is the end of the video. Now I hope to see you in the next one.